Hi candidates, welcome to our today's learning session. We will introduce a new topic which is known as enterprise value multiples. In this topic we will study the enterprise value multiples and its use in estimating equity value. We'll study the definition of cash flow, the momentum indicators and their use in valuation. Then we also learn about the sources of differences in cross-border valuation. So learners, welcome to today's lesson. The topic is enterprise value. The first question we need to answer is, what is enterprise value? Enterprise value. Enterprise value, candidates, is a total company value. It is the total company value. Enterprise value is the total company value. The total company value, and this value is determined by adding, number one, the market value of debt, market value of debt. We add the market value of common equity, market value of common equity, plus the market value of preferred equity, minus the cash and investments, minus cash investment. But if the company has minority interest, we can add minority interest first, minority interest, then we less cash and investments. We deduct cash and investments. So the enterprise value is equal to market value of debt plus market value of common equity plus market value of preferred equity plus minority interest minus cash and investments. Minus cash and investments. Now, candidates, why do we deduct cash and investments? What is the reason for deduction of cash and investments from the calculation of enterprise value? Now, the answer is, candidates, cash and investments, which is sometimes termed as the non-earning assets, they are subtracted because the enterprise value is designed to measure the price an acquirer would pay for a company as a whole. And we know that the acquirer must buy out the current equity and the debt providers, but then gets access to the cash and investments, which lower the net cost of the acquisition. So the same logic, candidates, also explains the use of the market values. The use of the market values. Remember here we are adding the market values of debt, the market values of common equity, the market values of preferred equity. The same logic applies. Because candidates, in purchasing debt, an acquirer would have to pay market prices. But we know that some debt may be private and not trade, or may be publicly traded, but trade may be infrequent. So candidates, when the analyst does not have market values, he uses the book values. These are values that are given in the balance sheet. So candidates, the enterprise value multiples relate the total value of a company as reflected in the market value of its capital from all the sources. And the purpose is to measure, which is a measure of operating earnings that are generated, such as the earnings before interest and tax, depreciation, and also the amortization. So in brief, candidates, that's the meaning of enterprise value multiple. Enterprise value, and I've said that enterprise value multiples relate the total value of the company as reflected in the market value of its capital from all sources to a measure of operating earnings generated, such as the earnings before interest, tax, depreciation, and amortization. Okay, what we call the EBITDA. EBITDA. Earnings before interest and tax, depreciation, and amortization. Candidates, what then are these enterprise value multiples? Enterprise value multiples. Enterprise value multiples. Enterprise value multiples. What are these enterprise value multiples? Candidates, the enterprise value multiples are just multiples that relate to the enterprise value of a company to some measure of value, typically a pre-interest income measure. And perhaps the most frequently advanced argument for using enterprise value multiples rather than the price multiples in valuation is that the enterprise value multiples are relatively less sensitive to the effects of financial leverage than price multiples when one is comparing companies that use different amounts of leverage. So the enterprise value multiples, in defining the numerator as they do, take a control perspective, and therefore even when leverage differences are not an issue, enterprise value multiples may complement the perspective of price multiples. And indeed, although some analysts strictly favor one type of multiple, other analysts report both price and enterprise value multiples. And in this lesson, we are going to learn how to calculate the enterprise value to EBITDA. The first multiple here, the first enterprise value multiple we discuss is the number one, enterprise value to EBITDA. Enterprise value to the EBITDA. We may have other enterprise values like the enterprise value to sales. We can have enterprise value to sales, and so on. In our today's session, we'll focus our attention on the enterprise value to EBITDA. And I've said EBITDA is the abbreviation for earnings before interest and tax, depreciation and amortization. Candidates, this multiple is by far the most widely used enterprise value multiple. And as you see here, it is just a ratio of enterprise value to EBITDA. In other words, this multiple, enterprise value to EBITDA, is calculated as enterprise value over EBITDA. The ratio of the enterprise value to EBITDA, where the enterprise value we determined, we know how to calculate the enterprise value. We say it is the value of the common stock plus market value of debt minus cash and investments. The enterprise value we saw is just market value of debt, market value of common equity, market value of preferred equity, plus minority interest minus cash and investments. Cash and investments. That is the enterprise value. The EBITDA, I repeat, is the earnings before interest and tax, depreciation and amortization. That is very important. So let's now work out an illustration. I'm going to work out an illustration which reads, an analyst started or gathered the following data for Mambo Industries. We have a table. The first item in the table is recent share price, which is 22 shillings. Shares outstanding, 40 million. Market value of debt, 137 million. Cash and marketable securities, 62.3 million. Investments, 327 million. Net income, 137.5 million. Interest expense, 6.9 million. Depreciation and amortization, 10.4 million. Taxes, 95.9 million. Required. Based on this information, calculate the earnings, the enterprise value to EBITDA ratio for Mambo Industries. Illustration. We are required to calculate the enterprise value to EBITDA. And we've seen the formula is enterprise value over EBITDA. These are the two inputs that will enable us to determine the enterprise value to EBITDA. We'll first calculate the enterprise value. Have a working here. Workings. First is the enterprise value. We say that the enterprise value is the market value of debt plus market value of common equity do we have preferred equity? No, we don't have preferred equity. We don't need to write it. So we only have the market value of debt. Then there is minus cash and investments. Cash and investments. The market value of debt is 137 million. 137 million. The market value of common equity, we have the outstanding shares 40 million. One share the recent share price 22.5 shillings. So we multiply 40 million times 22.5 shillings. This will give us the market value of common equity minus cash and marketable securities 62.3 million minus investments 327 million. This will give us the enterprise value. I'm going to add 40 times 22.5 plus 137 minus 62.3 minus 327. This is equal to 647.7 million. 647.7 million is the enterprise value. Then we calculate the EBITDA. We know EBITDA is equal to the earnings before interest and tax depreciation and amortization. From this question, we have the net income. This represents the earnings, the net income of 137.5. That is the net. So we are going to add back the interest of 6.9 million plus 6.9 million. We add back depreciation and amortization. There is also the tax of 95.9 plus tax 95.9 million. We add the depreciation and amortization 10.4 million. 10.4 million. That will give us the EBITDA 137.5 plus 6.9 plus 95.9 plus 10.4. The answer here is 250.7 million. 250.7 million is the EBITDA. Is the what? The EBITDA. So we will divide the enterprise value of 647.7 million. We divide by EBITDA 250.7 million to arrive at the answer, which is 247.7 divide 250.7. This is equal to 2.58, which is equivalent to 2.6 times. That is the ratio. 2.6 times is the enterprise value to EBITDA. 2.6 times. That is the answer to that question. And that will mark the end of our today's lesson, where we introduced the topic enterprise value multiples. We've defined the meaning of enterprise value. We've defined the meaning of enterprise value multiples. Then we've gone ahead to work out an illustration under the first enterprise value multiple, which is the enterprise value to EBITDA. Thank you for attending our today's lesson. We continue to learn more in regard to the topic enterprise value multiples. Bye-bye.